Good morning, and once again, welcome to a brand new week as we look at the WebTV Market Review, where we discuss the financial and capital market as it relates to the economy. And what better way to start the week as we look at the current big news story in the country, that our gross domestic product report for second quarter 2020 showed a contraction of -6.10%. That's for the National Bureau of Statistics, and we'll be discussing that today, implications of that to the financial and capital market. And we have Mr. Johnson Chukwu. He's the Group Managing Director of Cowry Asset Management here to discuss that implication to the financial and capital market. And good morning to you, and nice to have you on the show.
Good morning, Ottoabasi. Thank you for having me.
Yes, thank you. And for viewers, just briefly, let's give you a wrap-up of last week. That was on Thursday last week. We had the first ever Securities and Exchange Commission-led Capital Market Committee virtual meeting for the year 2020. It was attended by 240 stakeholders in the capital market. Chaired by the Director General of the Securities and Exchange Commission, Dr. Lamido Yuguda. He assured market participants of the Commission's collective commitment to continuing to implement the Capital Market Master Plan, which is running for 10 years and is expected to time out by 2025. He further promised to continuously seek ways of improving the initiatives in the Capital Market Master Plan designed for the development of the Nigerian capital markets, focusing on increasing the visibility and attractiveness of the capital market, and also ensuring that the environment enabling the framework for investment into the market. He noted that he will be implementing throughout and timely and expectedly affordable access to the capital market, zero tolerance for infractions, heightened investor confidence and awareness, innovative product development, and good governance practices. According to him, we need to restore investor confidence and attract the retail and young investor into the market. Interestingly also, the Financial Literacy Committee, which is involved in driving awareness on the market and creating sensitization, it was reported that the various trade groups have supported the efforts of the Financial Literacy Technical Committee with the sum of 78.3 million naira, out of which 34.7 million naira has been expended. That fund is designed to deepen awareness and orientation on the capital market and create interest in the market for investors, particularly the retail ones. So it was part of the key decisions and discussions at the first SEC CMC virtual meeting for the year 2020, looking at the capital market and focusing on how to boost investor confidence, particularly in times like this. We would continue to discuss around this in subsequent editions. Well, let's get on to the big story, the GDP report, a contraction, which is not isolated. Several other economies across the world have posted some contractions, and Japan, a G7 economy, is in recession. UK is also in a recession, and US is grappling with high unemployment rates. So, Mr. Johnson Chukwu, what's your first response on this GDP report that we received from National Bureau of Statistics today?
Well, what I would say it was much expected. I mean, we all were expecting that the GDP figure will come at a negative print. So coming at a print of 6.1% negative was not surprising to me, and I'm sure not surprising to a lot of analysts. Like you rightly pointed out, virtually all the economies that published their Q2 GDP figures have also reported negative growth. Of course, we know the economy was completely locked down or virtually locked down in the second quarter of this year. So anything to the contrary would have been a contradiction of the reality that we all saw in the second quarter of this year.
Yeah. Now, in terms of the impact on the Nigerian capital market, we've seen that, for example, the Q2 2020 financial reports of some companies showed the negative trend, and even some sectors like the oil and gas, agro, FMCG, and manufacturing posted several declines in performance. How will this further impact company operations, particularly those quoted in the Nigerian equities market?
You know, the truth is that the equities market is supposed to mirror the outlook, the fundamentals and outlook of an economy. If you have a contraction in your GDP or sectors of the GDP, then you should expect that to be different in the capital market. If you mentioned the oil and gas sector you mentioned, if you look at the GDP figure for the oil and gas sector, it actually contracted by 6.63% in the second quarter of this year. So operators in that sector, you should expect that it will also have a direct impact on their performance, which is also why we saw a decline in virtually all the published report from the quoted companies that are operating that sector. We saw the report from Seplat. We saw the report from the downstream operators. Most of them are downstream operators. Seplat is the only upstream operator in the market. We saw oil price collapse in the second quarter of this year. We also saw production, Nigerian crude production, that actually capped the volume that each of these crude producers in the country had to produce to align with the OPEC quota. Today, in the second quarter of this year, our crude production was only 1.81%, compared to 1.81 million barrels per day, compared to 2.07 million barrels per day in the first quarter of this year. So that was a material decline, about over 200,000 barrels per day decline in production, and at the same time when crude price collapsed. So these are reflective in the market performance of operators in that sector. The manufacturing sector also saw a decline in performance. So as expected, the operators in that sector had to bear part of that brunt. The few sectors that we saw the positive performance in the GDP, the agricultural sector, which grew by about 1.5%, the ICT sector, information and communication sector, and then the financial services sector. These are also reflected in the results that you are seeing from those sectors. If you see the top from the likes of Okumu Oil and Presco, you saw material improvement in their bottom line, their top line and bottom line, which is also showing that somehow the agricultural sector have been able to weather to some extent the economic crisis occasioned by COVID-19. Similarly, the performance of the ICT sector, we saw a lot of migration from physical interaction to virtual interaction, which should reflect in the profitability or earnings of operators in that sector. So the reality is that the capital market should be a mirror of what happens in the real sector, the real economy.
Yeah, so in terms of that mirroring the impacts on the economy and what we're seeing, that therefore means that Q3 2020, we're going to see more of impacted reports from companies across the sectors in terms of not so bright in terms of prospective results we'll be looking at.
Yes, expectedly. Like I said earlier, the capital market, people, when they invest in the capital market of instrument, you're actually investing particularly in equities, you're investing in the expected future cash flow stream of the company you're investing in. So if the outlook is that those cash flow streams will improve, then the prices of the equities will reflect those expectations. But if in the converse, it's expected that those cash flow projections are uncertain, may actually deteriorate, then the stock prices will actually reflect that. As it stands today, we expect that the third quarter GDP will still possibly be negative, but I don't think it will be as severe as the second quarter GDP that contracted by 6.1%. Of course, like I said earlier, the economy was virtually on lockdown in Q2 2020. Yeah. We have partially opened the economy. Some level of economic activities are taking place now. So we should expect that the impact of COVID-19 in Q3 2020 will be a lot of moderation from what it was in Q2 2020.
That moderation, even if you say, from what you're saying, if it's negative again, that means that's going to be a recession, because consecutive negative growth leads to a recession. So in essence, the country should brace for a recession and, of course, financial and capital markets.
Yes, Ottoabasi, by now, I mean, we've gone beyond the debate of whether the economy will likely go into a recession or not, because even if you look at the economic sustainability plan of the federal government, the government has actually made provision about the contraction about, even with the most likely scenario where they're going to inject about 2.3 trillion naira into the economy. They have made projection that the economy will contract by 0.59%. Even the most optimistic scenario, where they are expecting that they can inject about 3.6 trillion naira into the economy, they still expect that the economy will contract by almost 0.55%, 0.49%. So with the best of efforts, the government has accepted the reality that the economy will likely contract this year. If you look at the half-year GDP figure, when you look at the Q1 increase of 1.87%, and the Q2 decline of 6.1%. The effective impact on the H1 GDP is about 2.12% negative growth. So half of the year we're already contracted. So the extent of the contraction will now depend on what happened in the second half of the year. Like we all know, not all parts of the economy have been reopened. Schools have not reopened. International flights have not reopened, and then we are done 2 months of the 3 months in Q3.
Yeah. Now, in terms of policy steps, when you look at the ESP and several other interventions from the central bank and other efforts from the federal government, we even have a rollout of the National Youth Investment Fund, 75 billion naira fund from the Ministry of Youth and Sports, coordinating that tranche. Are these activities that can help once again stimulate various sectors to, at least like you say, moderate by third quarter and miss the fact that yes, it's inevitable that we're facing an economic challenge at this time?
Yeah, sure. Any stimulus will go some way in acting as at the minimum palliatives or to cushion the severity of the crisis, the economic crisis occasioned by COVID-19. Even like the economic sustainable plan you did mention, they have about 3 or 4 scenarios. Do nothing, 500 billion, 2.3 trillion, and 3.6 trillion naira. And each of these intervention will have a different outcome. The higher the intervention, the lower the contraction in the economy. So clearly, stimulus has a direct impact, positive impact on moderating the impact, the contraction of the economy or the severity of the economic implications of COVID-19. The clear thing is that is there an economy that can really come out of it without just because you have stimulus? Because there's also what we call natural growth or natural recovery. So even when you put in the stimulus, you still have to allow for some level of natural recovery. For that stimulus to be internalized, and you have to make sure you don't inject the level of stimulus into the economy that will create unintended negative consequences like runaway inflation. So you have to look at the absorption capacity of your economy, even when you are injecting stimulus into that economy.
Yeah, and that leads to the fact that we are currently in a stagflation employment and high inflation rates now with a contraction already. That shows that to some level, there should be some fiscal and monetary policy synergy in how they approach it, like World Bank and IMF have been making this case across and various other economies across the globe. Do you see that synergy in strategy from Nigeria? What areas, when you look at the ESP and other interventions, what areas would you like to see brought to the fore and addressed thoroughly at this time to really reset our economy?
What I would actually expect to see is a heightened level of activity on the fiscal side. In terms of synergy, if you look at the economic recovery sustainability plan, it's actually weighed heavily on the side of the monetary policy intervention. Of the 2.3 trillion naira the government plans to inject into the economy, more than 1.1 trillion of that is coming from the monetary side, the CBN intervention funds. So the other portion that is coming from the fiscal side, we need to see a heightened speed of implementation of those interventions. Take, for instance, what they call some of the funds they want to provide to the small and medium scale enterprises. As you know, the weight of the small and medium scale enterprise in the economy is too huge for us to ignore. 48% of the GDP is contributed by the small and medium scale enterprise, and 84% of employment is contributed by the small and medium scale enterprise. There's a survival fund that is an integral part of the economic sustainability plan, that the government is supposed to be paying salaries of employees of small and medium scale enterprises whose companies are unable to afford their salary payment. That way will inject liquidity into the hands of consumers and sustain consumption, and also make it easier for the economy to recover. I'm not sure that has been implemented. There's also a provision there for the government to offtake production of COVID-related items from the small and medium scale enterprises. I'm not aware that has also been implemented. Things like face masks, sanitizers, and all those items that are being produced by small and medium scale enterprises. These are little things that we can do to sustain employment, to increase level of liquidity available in the hands of the consumer. And then once you sustain consumption, it's easier for you to come out of economic recession because consumption will drive production.
Mm-hmm. And when you look at the equities market, with a lot of forecasts in terms of how it would close for the year, we've had like -4% forecast, -2%. The general agreement is that definitely is going to close negatively, coupled by the impact of the COVID-19 pandemic. How do you see this particular growth scenario impact equities market in the long run to the end of the year and investors' appetite?
Okay, like I said earlier, the equities market is supposed to mirror the performance of the general economy. So if the general economy is going to end with a negative, it's not out of place that the all-share index could actually end with a negative this year. We've seen a lot of zigzag movement in equities. We've seen instances where investors go to look for bargain hunting opportunities and quickly exit once they see small profits to lock in. So these things are expected to continue. And we should expect a sustained rally in the equities market until we have a clearer direction on the economic outlook of the country. Today, that outlook is a bit blurred. We are at most expecting that the economy will contract at a reasonably low digit. But as long as that outlook is negative as it stands today, we shouldn't expect that you're going to have a sustained bull run in the equities market.
Mm. This calls for a lot of innovation, Mr. Johnson Chukwu. For example, in the US, you have the NASDAQ, where all the tech companies are continuing to drive that rally in the US, amidst the fact that other sectors like the oil and gas, like you said, have posted huge losses. I mean, imagine the global oil majors like Shell, like Schlumberger, like Chevron, posting huge losses this time, and ExxonMobil. But the tech companies, the Apple, the Amazons, the Facebook, are still continuing to drive the rally. This is a opportunity to also leverage innovation. For example, we have the NSE Growth Board. I mean, various levels that can bring in companies that can deepen growth in the markets.
Yes, I mean, the good thing is that we've seen recently that two of the telco companies have now been quoted. I mean, for that reason, that's actually why you are seeing some level of moderation in the decline in the equities market, because this sector has actually turned out to be the winner or the beneficiary of the COVID-19 crisis. Mm-hmm. Yeah, so unlike the US, we have multiple numbers of telcos. As you know, about the capitalization of some of these telcos is almost 25% of the entire GDP.
Apple is $2 trillion now. Huge.
Thank you. So they account for a significant portion of the GDP of the US. I mean, their capitalization, market capitalization, is actually approaching that of the entire US economy. So the reality is that we still don't have that level of development in our telco subsector. When hopefully we should have a lot of these burden enterprises in that telco mature into the point where they can get listed, even if in the alternative market, the ISM market. So that way, we will have nurture them into the main board, and that they will act as kind of to balance the market indices as well as balance the market breadth.
Mm. And Mr. Chukwu, also, I know that you're part of the advocates for a vibrant and robust market. One area that would have really explored is leveraging the market for state-owned enterprises to be liberalized. For example, recently the Saudi Arabian exchange, the Tadawul, is currently market cap $2.1 trillion. And it has been attributed partly to the fact that it was able to list Saudi Aramco, its state oil company, which is one of the huge, valuable companies now, even in the globe. So looking at policies that can really encourage SOEs to come to the market and liberalize, like the state oil company, Nigerian National Petroleum Corporation, and Nigerian Liquefied Natural Gas. Soon we'll be seeing much advocacy, and even with the new leadership of the Securities Exchange Commission, driving this process, working with the government to ensure that we can bring more of these major state enterprises and even companies to list, like what we've seen with the telcos?
Okay, what I would actually think is that we should go beyond pushing the SOEs, the state-owned enterprises, to get listed. We have to actually first of all start by putting them in a structure they can actually be driven by forces of demand and supply, that is private sector rules. LNG can easily be listed because LNG is driven by private sector rules. The likes of NNPC is a very nebulous entity. The first thing is to unbundle it, which I hope that the oil and gas bill, that is the
industry bill, the
petroleum industry bill, will address that. You know, when the federal industry bill was first initiated, the plan was to have incorporated JVs, joint ventures, and then those incorporated joint ventures will operate as private, either privately limited liability company or publicly quoted limited liability companies, and they could come to the market, borrow money as any other private company, and then issue shares. Then the Nigerian National Petroleum Corporation will just be shareholder or holding the shares on behalf of the country in those incorporated joint ventures. Those joint ventures can easily come to be listed. So we're going to have multiples of that I listed, and instead of even pushing for NNPC under its current structure to be listed, I think the key thing is we need to unbundle NNPC and have the succeeding companies owned largely by private sector operator businesses, and then have them listed. That for me it should be the way. So we should focus more on privatizing a lot more of the state-owned enterprises and having them managed under private sector rules, which emphasize efficiency. Remember that public sector institutions, the motivations are different from that of private sector institutions. The simple reason whether you make money or not in a public institution, you get paid. In a private sector institution, you don't get paid because you earn from the income from which you get your salaries. So the motivations and incentive systems are different. The first thing, let's bring the incentive system and rules in the private sector organizations to prevail, to be the norm and the order of the day in those institutions, and then we can have them listed.
Mr. Johnson Chukwu, what will be your word concerning this development of the contraction, particularly to market operators and investors? What I read earlier from the virtual Security and Exchange Commission Capital Market Committee webinar for the year, because of the COVID-19 pandemic, the new DG of SEC, Dr. Lamido Yuguda, assured the market of zero tolerance for infractions, continuing with the capital market master plan, and also particularly driving regulation and activities that will boost retail investor confidence, which I agree with me that since 2008 has been very low and needs to be restored. What will your word concerning these areas?
Well, let me start from the concluding part of your question. To restore retail investors' confidence, that you must have a market that presents strong and positive potentials. In a market that is choppy, where you are seeing zigzag movement between stock prices, today you are seeing gains and losses. Like I said, use the word choppy. Retail investors do not have the competence to play in such market. They tend to stay away from the market because in most instances where they get into the market, they lose money because they really can't read the market. So the market must recover substantially to present strong positives. So that's that. Then the other part of your question, the key thing for us as a country and the capital market to do is to continue to drive for transparency, improve quality of reporting, like the DG said, zero tolerance for infractions. That way, institutional investors will be more comfortable, including foreign portfolio investors. They'll be more comfortable coming into our market to invest as long as the other factors are also positive, like exchange rate stability or harmonization of exchange rate. They'll be more confident coming to our market to invest because they can be less assured of the integrity of the financials that are published, and they know that the bet they're making on these stocks are based on non-fundamentals. So that for me is very key. The other aspect that I need to mention is that investors, there's still opportunity in the market that I did mention earlier that some sectors have remained bellwethers. The ICT sector has remained a bellwether, the Agric sector has made it very well, the financial services sector. So these sectors will see bold opportunities for investors to take positions in. Even the other sector that may not show positive growth this year, some of them actually have inherent strong fundamentals that if you're a medium to long-term investor, you should take position at the point when the stock prices are quite low and they hold out until the market and the economy recovers.
So the financial services, the ICT, and the agro value chain are still the sectors that promises hope for our market amidst the pandemic and the contractions we're seeing on the economy.
Yes, absolutely.
Well, a lot to watch out for from that space. But we would love to have you to talk further, but we know that you're pressed for time, and also we want to continue this conversation in subsequent editions. But thank you very much, Mr. Johnson Chukwu, Group Managing Director of Cowry Asset Management, for the time amidst your tight schedule to discuss around the second quarter GDP growth 2020 and implications for the capital market. Indeed, like you said, it's time to drive more transparency, accountability, and of course, put strong fundamentals in the market that will encourage investors. And of course, there are huge prospects, like you said, from the financial services, the information and communication technology, and also the agro space to drive growth and investments. Thank you once again for the time.
Thank you for having me.
Yes. And that was an interesting conversation
on the second quarter GDP 2020 growth in Nigeria, which we've said is minus 6.1%. There are prospects from what we saw in the economic activities sectors like the financial services, the information and communication technology, and the agro space are continuing to show that growth and drive the economy. So indeed, they will have implications on the capital market, the equities, and the stocks of all the companies in that space. And of course, we'll watch out for the third quarter to see if it's moderates and if we will eventually delve into that recession. That will be all for this conversation today on the market review. You can join our website, www.prochange.com, to watch our videos, read our news reports, and our analysis. Until we come your way for another edition tomorrow, we just want to remind you to stay safe for all our viewers. And please, also in this period, be aware of investments and schemes that are not regulated or registered by Securities and Exchange Commission. They promise you huge returns of 100 to 200%. They're all out to rip you off your hard-earned savings. We don't want you to experience that. Thank you for watching once again, and have a nice day.